Welcome back to MB Capital Strategies. Today we continue with the mining series. Today we're taking a look at Central Asia Metals, a stock that is currently flying completely under the radar for many. No hype, no big story, and no ESG marketing. Instead, two established mines, disciplined cash flow, minimal debt, and a very shareholder-friendly capital policy. Why is Central Asia Metals particularly interesting now in mid-January 2026? The broad mining sector has performed strongly. Many gold and copper mines have delivered massive returns in 2025 and early 2026. Copper is trading at over $5 per pound. That corresponds to around 11 to 13,000 US dollars per ton, so historically very high prices. With many producers, the share prices are overbought. RSI is high and valuations have increased. Central Asia Metals, on the other hand, is trading at around 197 pence as of January 16th. After a slight correction, the valuation remains low. We have an EV/EBITDA of around 5 and a PE ratio of about 10 to 13. Analysts are mostly positive about the stock. Moderate buy with price targets roughly between 185 and just over 200 pence. While other mines have already priced in a lot of future growth, Central Asia Metals is still clearly in the value and cash flow segment. Today we're only looking at the facts, no fantasies and no speculation. Let's also take a look here at how I am invested. In total, I hold 219 shares. My entry price is €1.85, a total of €405.48 invested. Currently, there is an unrealized gain of €102.60. That corresponds to a 25% price increase and a dividend of €5.39, which I have already received. The 52-week low is at €2 and currently we are at €2.30. The analysts have set a target of €2.28 here, and Investing Pro has set a price target of €3.20. I analyze all fundamental data with Investing Pro. If you also want to use Investing Pro, you can find the affiliate link below in the video description. By using my link, you get a 15% discount, even during promotions. Central Asia Metals operates exactly two assets, and that's not a disadvantage, but rather part of the strategy. We have Kounrad, copper from Kazakhstan, copper production from dumps, processed using the SX-EW method. I'll show you right here what exactly that means. And as a result, we have extremely low costs. Production costs are often below $1.50 per pound of copper. With market prices at $5 per pound, even during downturns, a very high margin remains. Important, hardly any new capital is needed. There is a natural decline in production over the years, but in return, the cash flow is extremely stable. In 2025, we produced 13,311 tons of copper. We met the guidance, and the fourth quarter was particularly strong despite previous weather-related issues. Then we have Sasa, zinc and lead in North Macedonia. Underground mine, conversion to dry stack tailings, significantly lower risk. Here as well, I'll briefly show what that means. Operational review for 2025 completed. In 2025, production was 17,881 tons of zinc and 25,156 tons of lead. Guidance met despite fluctuating ore grades. Central Asia Metals deliberately avoids aggressive growth, no risky exploration, and no destruction of capital. It is a pure cash flow operation from existing assets. Let's take a look at the numbers. The first half of 2025, revenue of $99.5 million US dollars, an EBITDA of $39.9 million US dollars, and an EBITDA margin of around 40%. Historically, the margin has often ranged between 45 and 50% and the operating margin between 25 and 35%. This shows that Central Asia Metals remains profitable even when metal prices are weaker. 2026 guidance published on January 8th. Copper, 12 to 13,000 tons, a slight decline. Zinc, 18,000 to 20,000 tons. Lead, 26 to 28,000 tons. and a CapEx of 14.5 to 17.5 million US dollars, with the majority allocated to Sasa. Sasa brings operational improvements to the top line. Now let's move on to cash flow, the crucial point. In the first half of 2025, an operating cash flow of 34 million US dollars. Adjusted free cash flow here is 16.2 million US dollars. Historically, operating cash flow has often ranged between 70 and 100 million US dollars per year. Free cash flow is almost always positive. 2025 was not a record year, but every dollar distributed came from real cash and not from debt. Shareholder returns, 4.5 pence interim dividend, and a 10 million US dollar share buyback program, which is still ongoing. Dividends plus buybacks, financed without leverage. That is anything but a given in the mining sector. Balance sheet for the first half of 2025 shows cash of around 48 million US dollars. Effectively a net cash position. Minimal short-term credit lines, operationally irrelevant. We have a debt-to-equity ratio close to zero. We have no refinancing risks and no interest rate trap. So we have full flexibility, which massively reduces downside risk. The dividend. Central Asia Metals follows a clear policy. 30 to 50% of free cash flow is distributed. In 2025, the interim dividend is at 4.5 pence. It was deliberately reduced to avoid paying debt-financed dividends and to enable additional share buybacks. The current yield is around 6 to 7%, historically often between 6 and 8% depending on the cycle. That's exactly how it should work in the commodities sector. Cash flow first, distribution afterwards. Here too, I would like to briefly touch on the comparison again. We can see that the benchmark in the mining sector has definitely risen sharply here. We see this here in blue, and red represents CAML, that is Central Asia Metals. So in theory, we still have a bit of catching up to do compared to the benchmark. So what are the risks here? Of course, first we have the factor that metal prices fluctuate. The ore grades at Sasa are variable. The political risks are manageable. Kazakhstan is stable and North Macedonia is an EU candidate. But we have no balance sheet risk, we have no survival risk, and we only have earnings volatility. In comparison, many gold and copper mines are now expensively valued. Central Asia Metals remains defensively positioned and fairly valued. So what is my conclusion? Central Asia Metals is not a 10 times growth play and not a trader hype. It is a cash flow strong dividend stock. We have a top balance sheet in the mining sector, and it is an ideal stable commodity building block. So for me, it's a good addition to my existing mining stocks. If you want real cash flows and don't feel like mining drama, then Central Asia Metals is an excellent fit for your portfolio. Now I'm interested in your opinion. What do you think about Central Asia Metals? Would you add Central Asia Metals to your portfolio or rather not? Feel free to write it in the comments. This video is not investment advice. If you enjoyed the video, I would appreciate it if you gave it a like. That helps the algorithm and also helps me to grow accordingly. If you're not a subscriber yet, I would be happy if you did so, especially if you want to further improve your cash flow. I wish you successful investing. See you in the next video.